Good afternoon, and welcome to It's Your Smarter Money with Steve Kraken and Laura Mattia. Today, you'll notice that we don't have any slides showing, and we'd prefer not to use slides right now because we want to just have a conversation with you about a couple of things that we've been discussing. Well, at least once a month, the investment committee meets, and we met last Friday to talk about where we are on our investing. And we discussed the uncertainty in the market. We talked about our strategies around value versus growth. And then we also talked about the current climate and what we are recommending and what we are doing. And we wanted to share some of that conversation with you today. So first, if we could talk about uncertainty, I've said this over and over again, that the fields of economics and forecasting is full of either people that don't know what they don't know, and those that don't know and those that don't know they don't know. And that's because economics is really an imprecise science. We rely on a lot of historical data, we make a lot of inferences, and forecasting can get very, very complicated. And human beings.
So, Laura, real quickly, I want to add a perfect example of that from last week. That jobs report that came out on Friday, I forgot whether it was Thursday or Friday. They expected that I think a couple more million, at least, jobs would have been lost, but instead, I think over 2 million jobs were gained, and that's one of the reasons why the market was up a couple of percent on Friday. That was entirely unexpected by almost every economist. So there is a prime example. And a lot of times it's not just on a short term, but it's also a lot of times on a long-term basis. And by the way, anybody who follows the Congressional Budget Office's projections, they're almost always wrong. I laugh when I see journalists quote them as if they're a sure thing. Their projections have almost always been wrong.
Right. Well, we're in a lot of uncertain territory right now, right? I mean, when you talk about the unemployment numbers, how did they factor in the stimulus and the moves by the Fed to determine how many people were going to be filing for unemployment? I mean, a lot of those things seem to have kept employment up pretty high, and they really don't know how to look at these things because we've never done anything like this before. I think.
We're in uncharted territory. And by the way, there is some anecdotal evidence, or at least some economists believe that part of the reason for the great jobs number last week in terms of partial recovery is because of the paycheck program, paycheck protection program. Sorry, and its effect on the unemployment. So say that 3 times fast.
But the real question then is it artificially propped up by free money, or is it in fact not? Will the economy catch to it, and or will the Fed and the Congress and the Treasury follow up and continue to maintain it? And so these are whole questions that nobody really can answer unless they have a crystal ball.
And I don't think they know what they're going to be doing yet either, quite honestly.
I don't think so.
No, and it depends on the data they see, and it's very, very hard to predict what's going to happen. Right. And just like we've seen with the market, I don't think any of us expected the market to almost, as of yesterday's close, actually go back to where it was on December 31st, at least the broader market, the S&P 500.
But this is so frustrating to all of us, right? It's frustrating to our clients, to all of you. It's frustrating to us because as human beings, we don't like uncertainty. We want to know the answers. We want to know what we need to do, and it can get kind of frustrating. And we want to say that while things may not be completely predictable, that doesn't mean that we're powerless and that we can't plan and make some good moves and decisions for our future. But we are, of course, looking at things like, the health and welfare of individuals. We really don't know what the final results will be around the virus and how people are going to behave, how people are going to be tested, how people are going to be treated, what about the vaccine, all these questions.
Whether there's going to be a second wave, we don't know. And Laura and I were just talking about it before we began the recording, that there's some anecdotal evidence from Italy and also from USMC. I forgot what that stands for. It's a university in Western Pennsylvania, that the virus could be, the virulence of the virus could be declining. In Italy, supposedly, there seem to be less, or I should say the cases that are coming into the hospitals now are exhibiting less severe uh, symptoms. So it could be declining in virulence, but that's a question. Now, by the way, viruses do tend to decline in virulence through time, but it could take years, not necessarily weeks. And the reason why that happens is because a virus, what happens is statistically, a virus that doesn't kill its host is more apt to survive and spread. And so, though if a virus mutates, the mutations that would be preferred would be the ones that don't kill its host and that they survive. There's no intelligence here with the virus. Obviously, it's just basically a protein shell with RNA or DNA in it. So we can't say that it's doing this intelligently. It's just a factor of what potentially could happen.
No, it makes sense. I'm with that. I like that answer, for sure. So we have these questions around health, and then we also have these questions around the economy and what's going to happen. Where are we in the business cycle exactly? Are we, we just had 11-year expansion, and are we continuing to move on that expansion track, or are we in fact uh, turning the corner? We don't really know that. And the
Yeah, and by the way, let's just mention what usually causes an economic contraction. Typically, some sort of distortions build up in the economy. Perhaps inventory is too high. Perhaps consumers are tapped because consumers represent about 70% of the economy, or possibly housing could be overpriced, like we saw in 2008. And we really didn't see any of those distortions in the economy prior to the virus.
and Steve, I don't know if you're gonna like what I'm gonna say here, but it also could be a distortion with potentially growth stocks being overly supported with this free cash, this extra money. Um, Money doesn't know where to go right now. If you put it in bonds, you're going to have very low interest rates. So, are we
Mm-hmm.
potentially propping up these growth stocks um, too much? It could potentially be a bubble, couldn't it?
I think that's certainly a fair argument one could make at this point, because a lot of money could still be in stocks or could have flowed back into stocks that may not really maybe shouldn't really be there, and it could be investors that really should be playing a risk off game rather than a risk on game,
Mm.
and it could be investors that could panic quickly because they really need that money in the short term or the near term, maybe 2 to 3 years, and perhaps they've jumped back into stocks because they saw the rally over the last couple of months.
Although the momentum continues to support growth stocks. Um, we saw some reversal in this past, actually since the mid May, where we actually started seeing some value, both in large cap as well as small cap, actually outperform some of the growth stocks. But that's still, uh, you know, cycling through, and we have to see that. But let's take a step back for a minute and actually define what is a growth stock and what is a value stock, because a lot of people don't really know. Growth sounds like it's a good idea. Why would we not want a growth stock? Well, a growth company is usually considered, um, the thought process behind it is that it has a good uh, chance of expansion over the next couple of years. And it's either because they have some products or product line that appears to be in high demand, or it might even be because there's excellent management of the company and the investors believe that this company is going somewhere. And so it usually is a little bit more speculative in nature. The company is usually not paying out dividends. They are taking all of their profits and they're retaining them in the company and investing it in new projects within the company, as opposed to value stocks, which tend to be larger, older types of companies, more established, and they tend to be dividend paying companies because they believe that they're uh, their cash needs are pretty well defined. They've been around a long time. They know what's going to be coming around the corner. And so they have no problem with releasing some of the profits to the stakeholders. And so generally, they
Yeah.
also will also tend to be stocks that are undervalued for some kind of reason. It could be because there was some type of perception around the business that made people hesitant, or something else is going on. But financially, the actual valuation of the business, of the company, is undervalued compared in terms of what people are paying compared to the fundamentals. And so,
So I like to think of it this way. Think Heinz versus a company that makes integrated circuits for artificial intelligence. And also a value company, you could be paying $3 per $1 of earnings, whereas for a growth company, you could be paying $10 per $1 in earnings. And the reason you're paying a lot more per dollar in earnings is that you think that the future potential value of that company is much higher than a company for which you're only paying $3 for a dollar of earnings. But that may or may not come to pass because those growth companies are also highly speculative at times. And also in the types of markets that they get into, there's a potential for enormous competition down the line. And I'll give you a perfect example. Look at companies that made home computers back in the 80s and 90s. Almost many of them are gone now. And even though it was an enormously growing sector of the economy back then, there was almost enormous competition. And it was also wasn't clear who was going to win that battle. And now we have obviously a stronger sense of who did win it. Lenovo, Dell, and some others. And think of some of the names that have passed into history. Gateway, for one, is gone. Northgate. So that's another way to view value versus growth.
right. And so people, I'm sure, want to know, well, which one is better? Is value better, or is it growth better? And growth definitely tends to be more volatile, for sure, right? And you would think that growth would actually outperform theoretically, but that's not always the case, right?
Not long term. Long term value has actually been at least equal, if not greater than growth, but with less volatility. And volatility is, of course, the traditional way most people, I would say, measure risk. They use this volatility measure. We won't talk about statistics here. We'll leave that out. But it's typically measured using a volatility factor. And I want to mention where some of this came from. If you go back into the history of finance, and we're not going to try to get too technical here, but there was a fellow called William F. Sharpe who said that you can actually identify much of the risk of a stock by looking at its volatility in relation to the market as a whole. And that factor is something he called beta. And over the years, they determined that maybe explained maybe 90% of the behavior of most stocks. So they felt that there were some other hidden factors that also explained part of the performance of a stock. And over the years, a lot of active managers tried to tell you that the other 10% came from their skill. But if that really wasn't true, if somebody could prove that just by having certain types of stocks, you could explain more of the performance of a stock or certain characteristics of the stock, it meant that manager skill is even harder to achieve and even less valuable. Well, a couple fellows actually did that. I think about 25 or 30 years ago. Their name was Fama and French, and they identified two other factors that seemed to be related to the performance of an individual stock, and those were the value factor and also the size factor. It seemed as though, and these, by the way, price to book, I think, was the factor they used, and they used size for the other factors I mentioned. Price to book is a value factor, and size means that small company stocks typically outperform large company stocks long term, of course, but with more risk. So that they turned the one factor model, beta, into a three factor model, which now explained, I think, 97 to 98% of the performance of stock further reducing the possibility that a skilled manager may have outperformed the market through their skill rather than choosing certain types of stocks. Now, they also, other researchers over the,
now.
yes,
Momentum.
exactly. Go ahead, Laura, you explain that.
Well, just the momentum component is another variable that was put into the model, and that I think probably is what we're seeing now is that is the variable that's been pushing a lot of the growth stock that we see is the momentum.
Yes. And so I want to mention about value versus growth. I think part of our conversation on Friday in our investment committee has growth been outperforming value? And it has, by the way, over the last 10 years for a lot of reasons. I think in part because some of the larger firms have done quite well, Amazon and some of the others, which I would really call them growth stocks. But that leads to a question is whether we should, I would say, change our traditional ratio of value versus growth to have more growth in it and less value. We've read other studies, though, that indicate that it's not so much that value is underperformed. Rather, it's more that growth has overperformed over the last 10 years. And investments tend to return to the long run average through time. So if we do move more toward growth, we could be chasing a cart that it's already, whatever the analogy is, we could be doing something after the fact. It may be too late to try to move more toward growth. Growth could regress to its long-term average and start to go back to its long-term return. And it would do that by underperforming value.
Last decade, value was ahead of growth. Certainly coming out of the even the downturns, value tends to do very well in the earlier stages of the business cycle too. And so value definitely has its place, and to rotate out of that, I would not be a supporter. We had a fairly lively discussion with members of the committee around this. It's part of this whole thing is just like the individual investors can get impacted by behavioral types of pulls and get lulled into a false sense of security where they start chasing returns. So can we as the leaders. However, we do have checks and balances, and we make sure that we're constantly challenging ourselves. Are we making this choice because we really believe something has changed fundamentally for in our overall beliefs, or are we making this change because we're just getting lulled into the herd?
When we do question our embedded thought, our embedded, I would say, methods and embedded, I would say, strategies, we're doing our job for you as a client, because it means that we know that we always need to retest our thinking and keep an open mind and make sure that we haven't just fallen into I would liken it to a train on one track, and that sometimes you do need to take a detour, or at least change direction. And so we do need to always look back at things and always say, are we on the right track? And that's part of the reason why we have these conversations and why they are lively, because we need to look back at our assumptions and either change the assumptions or reconfirm the assumptions that we've made.
And we don't come to these discussions unprepared. We've talked to other economists, we've talked to other advisors and other investors. We've read tons of articles. I know both Steve and I have stacks of articles that we're constantly going through and sharing with each other. Oh, this just came out today, or this is what this person's saying. So we come to these discussions, but it's just not just our opinion. It is our informed opinion.
We need evidence. We tend to be evidence based at Stonegate, Laura and I, and so we're very, very careful about the decisions we make, because we want solid evidence to back up our decisions rather than trying to guess.
Right. So we're always looking at all of our discussion, all of our decisions involve kind of three risks, if you will. And so diving into the growth stocks involves, first of all, the risk of um, that there'll be a decline, that there'll be a reversal, the average, number one, the average amount of risk, which is number two. And the third piece, which is always the thing that keeps us up at night, is the tail risk. How much risk is associated with this? How much exposure could we potentially be putting people into? And so that certainly gives us pause.
That's correct. So do you want to talk about what we are doing, Laura? Because we're not probably going to change our value versus growth ratio. We're probably going to keep it. It's roughly 2/3.
Absolutely. So we were refraining from rebalancing too quickly into, especially the one area that we would have rebalanced when the market declined, because it was the one that was driving it, was these growth stocks um, primarily. And we wanted to be very careful to do that. And part of the problem with doing that, on one hand, it seems to make sense because we're readjusting ourselves to a risk profile that was more consistent with your overall risk tolerance questionnaire and what we discussed with you in terms of how much risk you could take. But in an environment when things were getting so crazy and so quickly, um, things were moving to make your to allow your portfolio to become a little bit less risky by not rebalancing and holding on to those very valuable, consistent investments like your bonds. Just that seems to make the most sense for us. So we wanted to be more protective of your overall portfolios. And so initially, we did not want to make any kind of rash movement.
Especially with the uncertainty around the effect of the virus on the economy, and we really had no idea how much further the market could have dropped. I don't think anyone did, and the drop was so quick and over such a short period of time, and by such a large amount. I think the S&P was down 30% at one point, if not more, maybe 34. I could go back and check. We think that because of our three bucket theory, and bucket two are the bonds that you have, which are the safest bonds we could find, for us to justify selling part of your fixed income potentially to put it into a risky asset at that point, we think would not have been an intelligent thing to do.
Yeah, I did want to just go back to the uncertainty element, because I did want to just mention,
Sure.
We talked about the healthcare issues. We talked a little bit about the economy and where are we in the economy. We didn't mention a third real major uncertainty is all around political risk, which just seems to be getting more and more crazy every time I turn on the television set. And then even the fourth element is our international risks and uncertainty around our relationships um, with other countries, namely China. Um, there's just, sometimes you're just dealing with one risk or two risks, but we have risks on all sides.
We do.
So generally, we've been like I said, we've been refraining from the rebalancing, although we are starting to rebalance, particularly into some of the areas that we feel also have opportunity, like the value stocks, like small stack cap stocks, those kinds of things.
And I want to remind them that we also took advantage of the anomaly that existed in yield between municipal bonds and a lot of other bond categories. That was roughly about a month or so ago, and that anomaly has mostly disappeared. And we were able to take advantage of that by trading bonds, something we don't normally do, about a month ago in circumstances where it made sense.
Right. So overall, as the captains of the ship, if you will, we feel that it's our number one job to first protect you from worst case scenarios, make sure that we don't experience catastrophic risk, that we still have our bucket where we know we can go to if you need money. We have some other things. We still have exposure in growth stocks as well as value stocks. We have exposure in international and convertible bonds and a lot of other different asset classes that we want to talk more to you about and what those roles are. But suffice it to say, we're still believers in value stocks. We believe that it has had a little bit of uh, a period of time where it hasn't been as much in favor, but we don't think that that's a reason to just dump them. We think that eventually they will, everything is going to revert back and that they will have its opportunity to shine.
Yep.
So, with all of that, again, it's been great to connect with you once again. We will continue to have these videos to try to keep you aware of the things that we're thinking about and recommendations that we'd like you to consider. Um, After all, it is your smarter money.
I just want to mention one thing real quick, Laura. If anyone who watches this video thinks of a topic that you would be particularly interested in, feel free to send us an email or give us a call. We're welcome to ideas for topics. We have plenty. We could probably fill up a year at least. But if there's something that you're particularly interested in, let us know.
Great. And the other thing too is let us know how you feel about the fact that we did not use slides today. Do you like slides? Do you not like slides? Sometimes when we get into the slides, we start getting a little bit more technical and we don't want to lose people. So let us know how you feel about that too. So thank you. Have a great week.